critical mineral projects, they rarely fail because of the geology, right? They fail mostly because of the cap structure, the execution, and the timing.
Welcome to another episode of the Minerals Metals Initiative, a podcast exploring the transformation of the critical minerals industry as we race towards global resilience. I'm Alberto Rosende, your host and CEO of M2I Global. In today's episode, we will explore what it takes to move critical minerals projects from blueprint to execution, examining the capital, financing structure, and cross-sector coordination required to fund, build, and scale resilient mineral infrastructure. Which brings me to today's guest, Michael Woods. Michael is the president and managing member of Woods Capital, a global advisory firm focused on institutional financial structuring, modeling, and capital solutions. With over 3 decades of experience, he has led major investment platforms as CEO of Rothschild & Company Asset Management US and CEO of DWS Investments, where he oversaw global client strategy across the Americas. Across both his executive and advisory roles, Michael's work centers on navigating structural complexity and mobilizing capital to support large-scale, globally relevant investment opportunities. Michael, thanks again for taking the time and coming on to the show today.
Great to be here, Al. Thanks for having me.
Absolutely. Now, we just kind of looked at your background, and obviously it's very extensive in the finance and funding world. And so what we really wanted to take a look at, knowing that critical minerals is on the top of mind for everyone now, and especially with the administration stance, I just wanted to get your idea, generally speaking, of what the critical minerals industry looks like from the perspective of somebody in the capital markets and a financing perspective.
Okay, as we all know, it's never been a better time to be in this market, right? Not just as a national security risk, but also as a supply chain resilience need. And this isn't just a U.S. problem. This is a global problem. And we all know that China dominates, not just the mining side, but even more so the refining and the processing side. But the strongest message here is that critical mineral projects, they rarely fail because of the geology. Right? They fail mostly because of the cap structure, the execution, and the timing. And that's where we always come into play, is try to help our partners to get them really focused on that institutional structure, the timing to execution, the realistic view of your financial model, and the timing of each event within building your business.
Could you take us through what you would consider then a successful model to look at, knowing what you can learn from those that have not been successful?
Yeah, so you're talking about project execution, impact of capital there, which I totally agree. That's one of the easiest areas to get wrong quickly, right? So the biggest misconception that we see in critical minerals is that a good resource automatically becomes a good project, and it just doesn't. Capital is the bridge between resource potential and commercial reality. Let's say that again. Capital is the bridge between resource potential and commercial reality. And what I see repeatedly is companies spending years proving that geology, but very little time proving financeability or bankability. The market rewards projects that can demonstrate a clear path from resource to revenue. And in today's environment, capital should not just be thought of as just funding. Capital is also validation of the project, big time. When institutional investors, strategic partners, government agencies, and lenders, essentially all your financial counterparties, when they commit capital, they are effectively underwriting the project's credibility. And critical mineral and rare earth companies should remember that it's not just their reputation they're putting on the line for their project. It's also your cap stack members, them on the table, the shareholders. Reputation is on the line should the project fail, should you model it wrong, should something be misconstrued in any way. The absence of capital, let's also remember, is a vicious cycle. Without funding, permitting slows, engineering slows, offtake discussions stall, Construction timelines get extended all the time. All of us love those, new bills that come along. Costs increase. Investors become very nervous at this point, and what began as a financing challenge now becomes an execution challenge cycle that now gets really hard to break. So the projects that win, Al, that we see are the ones that understand capital formation must begin years before the first shovel hits the ground. And in critical minerals, capital is not the final step in development. Capital is part of the development process itself and needs to be prioritized as such.
So really important what you're pointing out is capital. It's a thread that's coming all the way from the real commencement of the thought of the project all the way through.
Has to start early, for sure.
So I know that there's been an awful lot of work done by the current administration and really the previous administrations in trying to get after supply chain resiliency and really focus on critical minerals. You can call it energy transition, you can call it the e-vehicle push from the previous administration. You can look at the national security and economic development imperative that the current administration is focused on it. So how do you tie the policy efforts to what Wall Street is willing to do? And then give us an assessment of the different, perspective that the current administration has taken and what effect that has had.
Yeah, there's a few pieces there.
Yeah, there are.
So the main thing that you're talking about is, where does part of it is approvability, permitting, focus, et cetera, but also where that government money, that the non-dilutive capital or the low interest, no interest loans or matching capital comes into the cap stack. This really did start with Trump 1, right? Where a lot of the focus started to get on critical minerals and reshoring critical technology manufacturing, right? That started with Trump 1.
Right.
And then Biden's administration continued it. So you then had all these bills that were coming, the Build Back Better. You had the Science and Chips Act, which includes critical minerals big time,
right,
to reshore. Then you had the Inflation Reduction Act, which, by the way, had nothing to do with inflation. Had a lot more to do with energy than anything else. Then, of course, you had the National Science Foundation Engine Awards,
right,
as well. So all of those initiatives came together to reshore manufacturing of critical technologies and to stand up more security around supply chain resilience. The thing that happened, I think, a little negatively on that was not at the government or the administration side, was more at the company side, because now there was this flurry of potential NOFOs, notices of funding opportunities, right? So all of these notices of funding opportunities come up from the government and NSF and states, et cetera. That became a drug for so many companies that was really hard to wean them off, and still hard to wean them off of that potential. Because look, if I'm running a company, I would want the no dilutive capital as well. The issue is your financial model really starts to break because of the timing it takes to be able to receive these awards, even if you are approved. And then making it such a high priority on your balance sheet, on your revenue lines for a contract, or whatever it may be, that really changes the whole dynamic of the investor returns over a certain time frame. So what we always talk about on the cap stack with folks is, yes, for sure, you should go after those NOFOs, right? You should always be looking at ways to find capital that's beneficial to your bottom line and benefits the project and returns a better return to your shareholders. For sure, go that direction, but discount it down, right? And discount it rather significantly, 40%, 30%. Therefore, if you are awarded, great. It's a big positive to your investor returns, because now you're going to decrease the amount of equity or debt, right? Whichever one you're applying for, you're going to decrease that down in your raise because it just got replaced,
right,
by a non-dilutive capital source, right? And that's fantastic for everybody. But if it doesn't happen or it gets delayed, or administration changes, or the environment changes, right? On prioritization of capital to different sectors,
Right.
right? All of that can change. If you discount it down, you have less risk to losing that or not receiving that award to your overall financial model.
That's fantastic. And I'd like to look at what you've just described. How does Wall Street, or how do funding partners look at the additional factors that the government may put in place that aren't necessarily financial, but that guarantee either profitability or guaranteed revenue because of purchases, floor limits on pricing, and those kinds of things? How is that integrated into the overall de-risking of the solutions capital stack that might be provided to an organization?
You're talking about a bit about those threshold levels for
Yes, sir.
qualifying portions of the awards. Yeah, exactly. So many of these notices of funding opportunities, they have multiple thresholds that you have to meet to receive a portion of the award.
Yep.
And many times with the a new construction of a refining, a recycling, a processing facility, a lot of times the awards are funded to the company mid to late stage, not early stage.
Mm-hmm.
So that private capital is really what gets you started. Some of your state initiatives will be earlier than federal initiatives,
Mm-hmm.
but your federal initiatives are usually mid to late. Maybe you get some state early. Private capital has to be early. So we at Wall Street, we actually like that because that means we have to partner
Mm-hmm.
early
Mm-hmm.
with you to help you to structure this business properly, institutionalize your model and all of your business concessions and planning, et cetera. Your data room to get that as tight as possible. That's where a lot of companies fail. They just don't get the data room right, and all of a sudden an analyst on another side just gives up. They're like, why do I got to keep searching for more information? Why isn't that just readily available? Right. So all of that should be very transparent for an investor. So we like the threshold level step progression of awards because that drug gets weaned off a little bit more on the front end. But then, of course, on the back end, we're also hoping that the company is successful to hit these milestones, these thresholds, so they can get that non-dilutive capital award. And we help them to get to that stage to increase the IRR and the MOIC, the multiple on invested capital, how many times your money you make over time, right? So we want them to hit those statistics. So it's actually good. It's good for the partnership between the company and Wall Street.
Let's take a look at the firms that are interested in this sector and how do they identify the ones that they believe will be winners versus losers. If you can kind of just take us through a couple of scenarios that way.
Well, yours for one, Al, right? With M2I, we're very excited about what you all are doing on the supply chain transparency and shoring up the depot, the storage for America. And thank you for what you're doing, and thank you for all the service that you've done as well. But the main thing we think is, as an investor, you're always trying to get ahead of a trend. You're trying to identify something earlier, right? Than the rest of Wall Street, which is really hard to do.
Right.
There's not that much arb anymore, right? Arbitration. It's really hard to guess something before somebody else does. And you caught, 5 points on a stock before Wall Street caught on. But the government is trying to play to the trends, not guess the trends, right?
Right.
So if I'm playing to a trend, that means that I know that, let's just take a few different ones. So let's say I'm looking at tungsten because I need tungsten for my missiles and my rockets and my armor, my bullets, et cetera. So I know that there's only really one major tungsten mine as a government outside of China control that's in Allied control, which is the Sangdong mine in South Korea. That's all I got. So I better protect that and put incentives into the market and anybody that's really focusing as a public company into that market, I better make sure they don't fail, right? And so I'm going to support them. Anybody that's pulling copper for the electrification of America, right? That's happening all across the board. Anybody that's doing black mass and everything that goes into black mass, your nickel, your cobalt, your manganese, your lithium, and others, right? So all of those critical supply needs that we have and the rest of the world has that is so dominated by China, it's the right thing for the government to not just give NOFOs. Of course, we need that for broad-based participation in creating more refineries, more supply chain channels, more processing, more recycling, because there's only going to be so much in the ground you can take out of
Right.
20 years from now, 30 years ago for our children and our grandchildren.
Right.
So you need the recycling efforts as well. So it's the right thing to both have the NOFOs at the top end for broad-based participation by many companies, but the direct investments on the bottom end to prioritized companies that are public, that they can support, grow faster, and really get them to enhance the supply, the storage, the use of those different critical minerals that are so in demand and we have so much of a small access to because China's dominated it.
So if we were to take it down and look at what kinds of questions are you trying to answer when you're looking at a project and analyze it before you start bringing in all of the other partners that will help fund a project? What are the things you're looking for? Going back to a term that you used earlier in the discussion, the bankability of the project.
I'd say there's really two areas primarily that we look at there. One is we want to make sure first at the top end of the company that we have the successful common characteristics that a investor partner is going to look at. Because as I mentioned before, it's not always about being the best project. It's about being the best managed project, right? That's where the money is going to flow. So successful projects have a few things in common. So we first look, okay, do they have strong management teams? Do they have realistic development timelines? Man, some of those are just not even close. Do they have strategic customers early in the process? Have they already developed those relationships? Has government aligned from the start? Is it a priority? Is it an area that they're going to get support in the future? Do they have phased capital deployment with realistic timelines? Usually not, right? That's usually where we come in to help. And do they have conservative assumptions? Because Al, the market sees through unrealistic enthusiasm all the time, right?
Right.
So we look at those, and then we look at the typical cap stack, right?
Mhm.
Where are we going to help them to find the capital that they need? And so we have to make sure that there's 5 main areas where they can get capital. And does it make sense for those areas to give them capital, to invest in this project? Strategic capital is a big one. As mentioned earlier, have they built relationships with OEMs, battery manufacturers, industrial partners, traders, the Traxxases, the Glencores, the Trafigura's, et cetera? Then equity capital. Do we think this would work for private equity and VC? Who knows, right? Are we pricing it right for private equity and VC? And I can guarantee you that answer is no, because no matter what we price this round at, the private equity and the VC company will have their own model. They'll come back. They will say, Mike, this is great. You guys are wonderful. We love working with you. But come on, you're just not going to get that number.
Right.
We want this number.
Right.
What about infrastructure funds? Does this make a good play in that vertical? Sovereign wealth funds would be great, but you got to be very careful that it's within play for them. And then, of course, family offices, single families, multifamilies, et cetera. But the real big part of this is making sure it's not just about the equity and the non-dilutive capital, but it's all about the debt capital and the project finance. So do we think this is bankable to commercial banks, export credit agencies, development finance institutions, infrastructure lenders, venture credit firms, et cetera? And then the project finance side, not just for the construction, of course, but the equipment financing, the operating debt. Where are they in a priority to build the relationships in this area? Because the challenge that all these projects have, it's not about finding one source of money. The challenge is orchestrating multiple sources of capital that each have different return profiles, return objectives, and risk tolerances. Equity is thinking different than debt, but debt will do nothing until you get your equity, right? So you have to balance them, even though you know you're orchestrating multiple different return objectives, right?
Right.
And then, of course, at the company level, it's all about your WACC. It's your weighted average cost of capital between all of this orchestration. So again, the best projects are not funded by one investor. They're really funded, the way to think of it, they're funded as an ecosystem, right? You've got to bring all of these multiple players together. This should be in your plan early on. Okay, I know all of these are potential funders. Which ones make sense? Which ones do I want to work with? Because not all money is good money in a project, right? Is this somebody I want on my cap table? Do I want this bank? Do I want this VC company? This may be the biggest trader out there. Do I want them as an offtake to give me a forward contract to help my cap stack? Those questions really should be talked about early. They should be agreed upon by both management and the board and the shareholders that come on in the first rounds.
Wow. So there's a lot to consider and a lot to plan. It's a concept that needs to be there at the beginning and all the way through the project development life cycle. So someone like you can really assist
100%.
in navigating that process. I'm glad that you're on our team. I'll tell you that much. So, but
Thank you.
but no,
there's a big part of that too, right?
Yeah.
So as a banker and as your financial partner, we can always bring potential strategics, investors, debt, project finance, et cetera. But at the end of the day, it's always the company's decision,
right.
right? We expect to be told, no, I don't want that investor. And if we weren't told that, we would ask the company, hey, wait a minute, you're saying yes to everything. This isn't normal, right? So
Right.
why aren't you pushing back a little bit more? So really, at the end of the day, it needs to be the company's decision for who they bring on the cap table.
There, you're almost interviewing the investor as well. But then you also should evaluate what are the interests that that investor is seeking. And if it doesn't work, you should be comfortable enough to say, thank you, but not now.
Not now, and we'll go back to work. We'll find other investors. And, of course, we're not talking to a few. We've targeted quite a few. And if the first two or three don't match, well, and sometimes they don't, and
Right.
that's okay. Let's move to the next.
Right. You addressed something a little while ago where you talked about the critical mineral repository that we're talking about. And I know that Project Vault has come in with EXIM support to be able to fund certain aspects to hedge against supply disruptions in that. So how does Wall Street look at those types of vehicles, repositories, whether they be private like ours or public sector supported? What are the questions that Wall Street looks at or tries to pose those participating in those repositories that they should be ready to answer?
I'll tell you, we're pretty excited about what you're doing for supply chain transparency, and also Project Vault is doing, and the repository model that's building. As you know, the critical mineral industry has historically suffered from fragmented information, right? Historically, it's been its problem. Every investor asks to see the same technical reports, the same environmental studies, the same engineering assessments, financial models, permitting documentation, et cetera, right?
Mhm.
But your repository models, such as a Project Vault, they are now creating a common source of truth, right? That the industry can depend upon. So this matters because we all, as investors, we spend significant time and money validating information. If we can standardize data access, project transparency, that all increases and transaction friction decreases, right? And in our view, Project Vault and similar projects like yours at M2I will become important infrastructure for capital formation because they reduce the due diligence inefficiency that we all suffer for, and they will for sure improve investor confidence. And on Wall Street, I think the easiest way to think of it is a Bloomberg analogy, right? Because Bloomberg, right? We compare Project Vault to what Bloomberg did for financial markets. So before Bloomberg, information was fragmented. Investors spent significant time gathering data on something they wanted to invest in before they could make an investment committee decision, right? Before they even brought anything to the investment committee decision. A ton of work goes into all of that data. So Bloomberg didn't create capital, right? They created transparency, right? So transparency accelerated with Bloomberg's help, decision-making, order and trade flow became faster, liquidity increased for different companies in different sectors, and capital confidence significantly expanded. So Project Vault has the potential to do something very similar that Bloomberg did for financial data for now critical mineral data in that, in that market. So transparency at the end of the day for these type of organizations, these kind of repository models, transparency lowers the friction. And when you lower friction, you lower the cost of capital without question.
So if we look at an extension of the same conversation we're having now and looking at the transparency required in pricing critical minerals, what do you look at in terms of Wall Street at being able to get to a point where we have a metals exchange and that we can actually have a spot price that is dependent on supply and demand rather than the manipulation maybe in China?
Well, that's a great question, right? Because, we've got two metals exchanges in the world, one in London, one in Shanghai.
Right.
Both of them owned by China. Is there manipulation going on? Well, for sure, you have dumping going on. That's been proven. Does that manipulate a price? 100%.
Absolutely. Yeah.
It manipulates a price. So, yes, there is manipulation going on. At the exchange level, I'm not sure. But here in America, not having a metals exchange is a really big weakness, without question. Having a metal exchange here that can, like you say, have another source of spot pricing methodology that is localized, that can compete, contrast sometimes, and challenge the metals exchange in both of those geographies so that just like gold should follow the sun, right?
Yeah.
Right. The Rothschilds used to price gold every day in London, and then the price of gold would follow the sun. So same thing. If we had another exchange here in America that you now start in London and start moving that price along the sun line, right, we would have a similar process that we used to have that we should really have now, without question. So we'd be big fans of having a metals exchange here. Now the question also becomes, where do you put it on a blockchain, right? Which would be, right, likely the right thing to do because you don't have any manipulation ability, right? And everything is immutable on a blockchain system. So we'd love to see something like that happen. And I know you're working at it at M2I to make that happen. And we wish you all the best of luck there. We want that to happen.
So as we're looking at everything that we've looked at, the landscape that we've discussed, what would be some of the key points that you would want to make sure that are kind of the memorable pieces to take away from our dialogue?
So first, if I would leave the audience with this. One, stop treating private capital formation as a later stage activity and reduce, I'm not saying eliminate, I'm just saying reduce the dependence on government incentives.
Right.
Plan for that non-dilutive capital as a secondary and nice to have capital rather than a dependence to your financial model. Secondly, develop projects as integrated supply chain assets. The winners will not simply mine their materials. They're going to process, refine, connect directly into that whole strategic manufacturing ecosystem. Build your business as an integrated supply chain from the beginning.
Right.
And then lastly, I would just build an institutional grade transparency. Right? The energy transition and the national security that we talked about, all those objectives, they're going to require trillions of dollars of investment. That capital will only flow when projects provide the transparency, governance, and execution discipline that we talked about, which investors expect. They're not looking for it anymore. They expect it.
Right.
And they don't see it, you're gone. The critical minerals industry has an extraordinary opportunity today. It is not a better time. I got to tell you this, probably since the 40s and 50s for critical minerals and rare earths. Demand fundamentals are strong. Government support is strong and continues to get stronger and growing. Strategic necessity has never been more clear, ever, for us to focus on this area. So the question is no longer whether these projects need to be built. The question is whether we can organize capital efficiently enough to build hundreds of them. That's the big question.
That's awesome. Michael, thanks for your time and also the investment and time it took for you to prepare for our session today. You've contributed an awful lot of information for us to really digest. So thanks again for your time.
My pleasure. It's been great being on the show with you. We love what you're doing, Al. Thank you for continuing this podcast in many different sectors and different areas that are important for the investment community, and most especially for this industry. Thank you for having me on.
My pleasure. Thanks again. And to everyone who listened or watched this episode, thank you for joining us. Be sure to follow us on Spotify and Apple Podcasts to keep enjoying the Minerals and Metals Initiative.